Hello traders. So today we're going to learn short options, selling calls and puts. So let's get into it. All right. What do we mean with short? When you sell an option, so when you go short an option, you receive a premium up front. So we receive some money up front and we need to accept an obligation. So people like shorting options because you get money up front, but you need also to consider that in this case, you're accepting an obligation. So if you short a call, you have the obligation to sell shares at the strike you chose. And if you short a put, you have the obligation to buy the shares at the strike you chose. So it's nice to have premium up front, but you need to consider that you're taking some risk. With long options, if you remember, we have the right, but not the obligation to buy, for example, stock. Here we have an obligation. So basically, what happens when we sell a call and why do we sell a call? We sell a call when we believe that the price will stay below the strike that we choose or that the stock will move down. So in this example, in this chart, we sold the call at this level because we believe that the stock will keep moving down or will stay below this level. That's all we need. So if the price stays below the strike, we keep the premium that we got up front. If the price rises above the strike, the losses are growing as the price rises. That's why they call short option naked options, because you have no protection. So it's very dangerous. And we will talk about that. So short calls profit from nothing happening. So the stock might just stay here without going up or down. We're still making profit. It's more of a theta kind of trade. So if the price stays below or nothing happens, just stays in this area, the important thing is it's below the strike, we're making money. Actually, we keep the money. Let's make a real example. So we have this stock that now is trading at $100. Okay. We think that the stock was going to keep staying around here or keep moving down. So we sold a call at 105 strike. The money that we got up front, the premium is $2. So we have $2 credit. Remember that a contract is 100 shares. So for $2, we have $200 of premium. Okay. So at expiration, if we are below 105, we make a profit of 200. And that's it. We don't make more than that. That's fixed. That's all you can make. If the stock goes to 110, we have a loss. In this example, 100 minus 105 times 100 minus 200 is $300 loss. But it can go worse. If the stock moves higher up to 120, we can get until a loss of minus $1,300. So that's the problem of shorting options. You can only make $200, but the price can go so badly against you that you lose so much. That's why it's very risky. For the puts is a similar concept, but let's say upside down. So when you sell a put, you believe that the price will stay above the strike, this level that you chose, or that anyway, the stock is going to move up. So we sell a put at this level, because we think that the stock is going to stay above this level or even moving higher. If the price stays above the strike, we keep the premium. So the money that we got up front. If the price falls, you might be assigned. So you'll be forced to buy shares. Now, short puts are a nice thing actually, because they're often pitched as getting paid to buy the dip. Why? Because if I think that the stock moves up, or anyway, stays above this level, and I sell a put, yes, I'm going to make profit if the stock moves up or stay above this level. But if the stock moves down, we're going to buy stock. We're going to be assigned. So we will be forced to buy shares. And that could be good if the stock moves down a lot, you get assigned. So you buy the stock at a lower price. And on top of it, you get paid the premium because you sold a put. That's actually, guys, the way that Warren Buffett made billions on the S&P selling puts. He literally bought the dip and got paid to buy the dip because he also sold a put, which is, it's amazing. But you need to be careful because the stock might not recover. It might be a falling knife and you're trying to buy the dip and then everything collapses. So you need to be very careful. And you need to have the capital. So let's make an example of the short put. We have the stock now is trading at $100. We think that it's going to stay above this level or keep going higher. So we sell a put at 95 strike and we got up from $2.50 a credit. Per 100, it's 250. Because remember, one contract is 100 shares. So we would be at break even by just subtracting the premium from the strike. So 95 minus 250 gives us 92.50. So that would be our break even. At expiration, okay, if the stock is above 95, above this level, we make $250, and that's the maximum we make. If the stock is at 90, let's say it moves lower, we have a loss of $250. If it keeps moving down, we have a bigger loss. Look, if it goes, for example, to 70, down to 70, we can lose up to $2,250. So that's the maximum you can get. At 250 is the maximum you make, but if the stock crumbles down, the losses are going to become very big and fast. Again, shorting options, having naked options is dangerous. People obviously likes to sell options because what we benefit from time decay. As I said before, this is a theta trade because we don't need the stock to do nothing apart from being above or below the level that we chose. And then the time decay is going to do the rest of the work. So you can just sell an option, sit down comfortably and just wait the time to pass and you're going to make money. It works well on sideways market because again, you don't need the stock to go anywhere. It doesn't need to go necessarily up or down. You can just stay where it is. Important is above or below the level you chose. And you can make, it's more probable for you to make money, but obviously the wins will be smaller. So little tiny wins. Because obviously if it's easier, it's less, there's more chance to make money. The wins are going to be smaller. So, and remember, the small wins though come with big losses. So everything is nice and fine and funny until you're wrong and the losses pile up so quickly that it's not even worth it anymore. So selling options can feel addictive and it often works. As I said, you can have small and repeated wins. When volatility hits you, you're going to be in pain, a lot of pain. So the risk, what is that makes this short option so dangerous? Number one, we need to remember the profit is capped. You receive the premium in advance and that's all you're going to get. But the losses can be very large or unlimited. The margin can increase suddenly. And you have also assignment risk. Do you want to get assigned stock? Do you want to pay for stock? Do you have the capital? What's your strategy? So it's very difficult. Volatility spikes can blow out prices very fast. So risk can expand quickly, especially when we have market shocks and you find it a very uncomfortable situation. What's the safest approach? Professionals, option traders, what do? They sell an option, not by itself, never by itself. Even because most brokerages don't even allow you to do that. So you sell an option, but to cover yourself, you need to buy another option together. So the combination of short option and long option is the sweet spot. It's what professional traders are doing. And that's where you want to be. That's why we have this defined risk strategy like credit and debit spreads, which I love, iron condors and butterflies. These are all strategies that and not leaving you naked. So when you sell an option, you're also at the same time buying another option that is creating a spread and that is protecting you, but that's something for other lessons. I hope everything was clear and I'll see you next time.